Let's be real for a second. Recessions feel like the worst time to invest. Everything's red. Your portfolio looks like a crime scene. People are panicking. And the news? It's basically screaming the world is ending. But here's the secret no one tells you loud enough. Recessions are actually the most powerful time to build long-term wealth through compounding. This is where the real ones separate from the rest. So in this video, I'm going to break down how to compound investments during recession times, even if you're scared, even if you're starting small, and even if everything around you feels like it's collapsing. Stick with me to the end because I promise once this clicks, you'll stop fearing recessions and start seeing them as your biggest wealth-building opportunity. 1. Understand what compounding really is. Compounding isn't just earning interest, that's the boring textbook definition. Real compounding is when your money starts working harder than you do. You make a smart move. That smart move makes you a little money, and then that money starts making more money. This is exponential growth, like planting a tiny seed, and over time, it turns into a forest of cash tree if you stay patient and consistent. But here's the trick. Compounding works best when you buy low and hold long. And guess when things are the lowest? Yup, during recessions. 2. Why recessions are a gift. Let's pause here and acknowledge something real. Recessions are scary. People lose jobs. Companies shut down. Uncertainty is everywhere. But financially, recessions create discounts, massive ones. Stocks that were $100 are now $60. Real estate that was overpriced is now begging for offers. Dividend yields that were 2% are now pushing 5% or more. In short, you're buying the same assets at a steep discount. Think about this. The people who got rich after the 2008 crash? They weren't buying at the top in 2007. They were buying when everyone else was too afraid to. Compounding in a recession isn't about timing the bottom. It's about consistently investing while things are down and letting time do the heavy lifting. 3. Start with what you have, not what you wish you had. One of the biggest myths is that you need a lot of money to start compounding. That's a lie. You need consistency, not cash flow. Even if you're investing $50 a week, $100 a month, that builds, especially during a recession when prices are low. When the market eventually recovers, and it always does, that small amount you kept investing turns into a snowball rolling downhill. Think about it. Would you rather invest $1,000 when the market is at an all-time high or the same $1,000 when everything is 30% off? Start small. Start scared, but just start. 4. Buy quality. When everyone's running for the exit. This is where strategy matters. Not all investments are built the same. During a recession, some companies go bankrupt, others barely survive, but a few, they thrive. These are the blue-chip companies, the dividend payers, the market leaders. Look for businesses that have strong cash flow, pay consistent dividends, have been through previous recessions, and solve real-world problems. These companies don't just survive downturns, they often come out stronger. And when you buy them during a panic and reinvest the dividends over time, that's the fuel for compounding. 5. Reinvest everything, even when you want to take it out. It's not just about price appreciation. It's about reinvesting the earnings from those companies over and over again. This one's hard because when things get shaky, the instinct is to pull out and protect what's left. But if you want to compound through a recession, you've got to do the opposite. Reinvest your dividends and capital gains. Every single cent you leave in the game of investing is a soldier working for you. Over time, they bring in more soldiers, and that's how empires are built. Let's say you own a stock that pays $200 in dividends during a down market. Instead of cashing out and grabbing lunch, you reinvest that into more shares at a lower price. That reinvestment earns you more in the next years. It's not magic. It's just consistency plus discipline. 6. Automate your investing and take your feelings out of it. Your emotions will lie to you during a recession. They'll say, "Don't invest, it's too risky. Wait for things to get better." Or, "Let's just hold cash." But you know what? The market doesn't care how you feel. It just moves up, down, and sideways. And those who stay consistent ride the wave while everyone else tries to time it and ends up missing out. The solution? Automate everything. Set up automatic transfers, choose a fixed amount, and put it into a diversified index fund, dividend ETF, or individual stocks you believe in. Whether the market's up or down, invest anyway. This removes your feelings from the equation, which is honestly your biggest superpower in a recession. 7. Think in years, not months or days. This part is hard but necessary. Recessions are temporary. The economy recovers, the market rebounds, and the panic fades. But most people act like every day is the final day. They check their portfolios every morning like it's a horror movie. That's not investing, that's stress. If you're trying to compound your investments, your timeline has to be measured in years or decades. When you zoom out and look at any recession, the dot-com crash, 2008, even 2020, you'll see a pattern. The people who held on, kept investing, and stayed consistent came out way richer than those who panicked and sold. So when things are ugly, remind yourself that this is temporary and your plan is long-term. You're not day trading emotions, you're building wealth. 8. Diversify, but stay focused. Recessions can expose weak spots. That's why diversification matters. Spread your investments across index funds, dividend stocks, gold, or even some alternative assets if you're experienced. But don't confuse diversification with distraction. Stick to what you understand. Don't chase trends and don't let FOMO drive your moves. Compounding loves focus. Choose a few solid investments, master them, and let the magic happen over time. 9. Control what you can and ignore the noise. You can't control interest rates, inflation, market crashes, or the headlines, but you can control how much you invest, how often you invest, where you invest, and your mindset. And these 4 things make all the difference. Don't let the noise take you off your path. Recessions are loud, but compounding is quiet. It doesn't shout. It doesn't trend. It just builds slowly, patiently, and powerfully. 10. Use the downtime to learn, not to panic. If you're not confident or you're feeling overwhelmed, this is your golden chance to educate yourself. Read books, watch videos like this, learn the strategies, and understand the psychology behind compounding. Because the more you understand, the less likely you are to panic. Recessions are emotional, but if your knowledge is strong, you'll stay calm when everyone else is losing their minds. And that calm, it pays dividends, literally. Here's the bottom line. Recessions are not the end of your financial story. They're the plot twist that makes the comeback legendary. This is where generational wealth gets built, not during the highs, but in the lows. So don't be scared, don't be frozen, and don't be tricked into sitting on the sidelines while everything's on sale. Because 5, 10, 20 years from now, when people ask how you built your wealth, you'll say, "During the recession, when everyone else was running, I stayed, I built, and let my investments compound." That's the difference. That's how you win.